So, what is a vanilla mortgage loan? I started doing mortgage loans or in the business in 1996. I have about 25 years experience heavy in mortgage origination and qualification. And I wanted to explain what we used to refer to as a vanilla mortgage. And when you hear mortgage rates on TV or you see an advertisement at a bank and it says, oh, we offer, 3.75 interest rate, and you call and they quote you 4.75, and you can't understand why, and they try to explain it to you, but you really kind of feel like it's a bait and switch situation going on, which used to be very popular, and honestly, it does still happen now, just not as rampant. We have a lot of regulations that prevent the banks from doing that, but when they are quoting you an interest rate, this is what that caveat is based on. So you have your down payment or the equity that you have in your home if you're doing a refinance. So if you're buying a $200,000 house, the bank is going to look for you to put $40,000 down. That's going to be 20% of the sales price, or for you to have that much equity into your home. Now, if you exceed that, then you are going to get an adjustment to your interest rate based on that risk. So if you're only putting 5% down, your rate is going to be significantly more than someone that puts 20% down. In addition to that, say you put 50% down, then you're going to have an adjustment for that, and you can actually get a little bit lower interest rate. But the bar is going to be set at 20% down or 80% of your loan to value. Your loan to value simply is just the sales price or the appraised value of your home versus what you're wanting to borrow. Now, the other thing that they're going to look at is the occupancy. What are you buying this home for, or what is this home to you? Um, and it is, you're going to, the caveat is to be a primary residence. If you are buying this as a secondary residence, you may or may not have an adjustment for that. It just depends on your credit score and a lot of different things. Normally, you will have a slight adjustment for a second home, but it's not going to be devastating. Now, if you are buying it as an investment property, then that's going to be a significant increase to your rate based off of the risk that you're not going to, occupy this residence. If something goes wrong in your life, that's going to be the first thing to go is your investment property. And the other thing is, what type of property are you buying? These rates are going to be based off of a single family residence, a normal home, just single family dwelling. Um, it is not going to allow manufactured homes or duplexes or triplexes or whatever. And if they do allow that, then you are going to have another additional addition to your rate based off of if you have some type of obscure house that you're wanting to buy, or say you're wanting to buy a quadplex and you want to live in one unit and you want to rent out the other three. Well, the banks may do that, but you're going to pay a higher interest rate because of the risk associated with that. And all of these risks are based off of performance of previous mortgage loans and previous loans programs that the banks and Fannie Mae and Freddie Mac and the government had offered, throughout the years. The other caveat that you have to look at is your credit score, of course. If you have normally a 780 or above is going to fit you in that caveat. Banks are going to start hitting you slightly when you get to 760 and 740. You'll pay maybe just a tad bit more. But if you drop down below 700, your rate is going to start adjusting significantly the lower that score gets. And normally the bottom baseline that they'll accept is normally a 620. I'm not even sure if it may be higher than that. They definitely do not want to lend on, high loan to value, 0% down mortgages for, you know, a manufactured home with a 620 credit score and all of these different layers of risk. And you can actually get to a level of risk associated with the pricing of your mortgage loan that it will price you out legally of being able to do the transaction, because once your APR reaches a certain point, we have to run APR tests, and it lets us know if we are outside of federal guidelines. So I hope that this helps. A lot of people, I've worked with a ton of borrowers, and this is the number one complaint, is they feel like, well, you advertise this rate, and now I call, and y'all do 5% down mortgages, but now you're telling me the rate's different. Well, yes, it is. We can't, or the banks can't issue out rates based off of every individual, criteria. There are just too many moving parts in a mortgage. Is like a living, breathing entity, and that's one thing that makes them so difficult. So I hope you found this helpful. That was my intent, and I hope you have a great day.